Hi, according to Keynes, money demand is preference for liquidity. That means people have desire to hold cash or any asset which they can convert into cash very quickly. And people do money demand mainly for three motives: transaction motive, precautionary motive, and speculative motive. Transaction motive, money needed for day to day transaction. For example, I need money to buy grocery, clothes. Transaction demand for money is function of income. As income increase, transaction demand for money also increase. Precautionary motive, people wish to hold cash for any future emergency. For example, sickness, accident, fear of unemployment. Precautionary demand for money also function of income. As income increase, precautionary demand for money also increase. Speculative motive, people have desire to hold cash so that in future they can invest this money and take advantage of future investment opportunity. Speculative demand for money and interest rate have inverse relation. Interest rate fall, speculative demand for money increase. Interest rate increase, speculative demand for money fall. For example, currently interest rate is very high, that's why speculative demand for money fall. But why? Speculative demand for money means you wish to hold cash so that in future you can invest this money. If currently interest rate is very high, then why should you wait for future? You immediately invest your money in bonds rather than saving for future. Speculative demand for money, interest rate, both have inverse relation. As interest rate increase, speculative demand for money fall. Liquidity preference curve, or interest rate is very low interest rate. At this interest rate, people don't want to invest in money market. That's why after a point, liquidity preference curve become horizontal, which shows people have absolute preference for liquidity. They don't want to invest in money market. They just want to hold all cash which they kept for speculative motive. That's why this part will be called liquidity trap.